You know, what's interesting is about trustee investing, it's when you really understand that's basically all it is. You're a lender instead of the borrower.
Right.
It seems so simple, and yet it's really not that easy to be successful at it, because we see a lot of people do it on their own and sometimes with not such good results.
Yeah, for a simple concepts, there's a lot of very, very definite things that you want to watch out for, which I'm sure we'll get into. But
sure.
It's a very simple concept that has a lot of directions you can go.
Basically, if we're talking to an audience that really isn't familiar with it, there's a couple of pieces of papers that are always a part of a transaction: a trust deed and a promissory note. So, can you describe what a promissory note is?
Yeah. Essentially, both of those, promissory note is simply almost what it says. It's when you promise to pay someone back.
Okay.
So you're promising to pay someone back under certain terms, certain conditions, over a period of time.
And as it turned out, that's kind of an important piece of paper to hang on to.
Yeah, absolutely.
Okay.
Yeah, you want to keep that. And then, as you mentioned before, the deed of trust, what that makes it different, that actually attaches it to a piece of property.
Okay, and that gets accomplished by recording at
Yes.
the recorder's office.
Yes.
Okay. In the deed of trust, there's 3 participants. You have a trustor, a trustee, and a beneficiary.
Yes.
So just briefly describe who those guys are.
Sure. The beneficiary, that would be the person that's actually lending the money.
Okay.
The trustor, that would be the person simply that's borrowing the money.
Okay.
And the trustee is more or less, we serve as the trustee on ours, and what they're doing is some of the servicing aspects. One example of that is when a loan is paid off, the trustee handles the reconveyance.
Okay.
So essentially they're doing some of the paperwork on the backside and things of that nature.
Okay, and in a rare case, that document allows the trustee to proceed with a foreclosure if that ever became necessary.
Absolutely, yes.
Okay. There are 3 participants involved in a trust deed investment as well. So you have a borrower, and you have a lender, and you have a broker.
Yes.
And you know, we'll cover that a little bit more as we go through this, but a lot of people don't really understand the importance of the broker being in the middle. And you know, that's, again, we've seen people try to take that on themselves, and that just, it's not even necessary.
Right, and one reason it's not necessary, because I think one reason people tend to say want to do things on their own because they can make more.
Right.
I mean, I think that's the one reason we all do something is, well, I can make more, it'll cost me less. Those are the 2 things.
Right.
Well, interestingly enough, by using a broker, you're actually legally allowed to get a higher yield than you would be on your own, and that's because of the usury laws with regards to trust deeds.
And I think in every other case, when we think of broker participating like a listing agent, even though I would use one 100% of the time rather than sell it myself, the concept is, well, if I could only sell it myself, I'd make more. Right. You know, and if I could buy stocks direct, I would spend less.
Right.
This is one case where it actually, the broker doesn't charge anything to the person with the money that puts up for the trust deed investment.
Exactly. They're just the borrower is the one that's paying all the fees to the broker, so that it doesn't impact the beneficiary or the lender.
What would you say are some of the main reasons that investors decide to put some of their money in trust deeds?
Well, I think there's a lot of reasons. I mean, just as an example, I mean, you and I do it.
Yeah.
So you know, there's a lot of different people that do it. I think the majority of the people that we get they're more concerned about, say, maintaining wealth, and not necessarily even that they're wealthy, but they really don't want to risk what they have. So they want a consistent return, a high yield, and they want something that they feel pretty safe with, and something that they understand. And as we talked about earlier, stocks, a lot of people maybe understand or they don't, but most people do understand the concept of, you know, I have a mortgage on that piece of property. Like,
yeah.
They can understand that. It's a very simple concept, and one that the majority of the people feel pretty safe with.
I think people also, when you invest in stocks, you don't really feel in control of anything.
Right.
It's very volatile, and I think at some point in your life you just go, okay, volatility is really not too exciting for my investments.
Right.
I prefer something that's more stable. So even though this is what can be considered an alternative investment, the people that invest in these trustees are actually fairly conservative.
Yeah, I mean, the majority of them are. I mean, that's what's interesting. This certainly, if you were to look at our base of investors, they're certainly not risk takers.
Right. It's not the roll the dice crowd.
No, it's really not. And as we've gone further along, I think it's become more and more, even more conservative, where people are deciding to take retirement funds, or we have this whole new level of investors that are coming in, and they're just deciding that, you know what, to make 9%, let's say, on this investment certainly is a lot better than having the 1% in the bank. So that group is really starting to make that decision that it makes sense for them.
Plus the fact that it's secured on a piece of property and it's got a monthly payment attached to it.
Exactly.
Those are big items.
Exactly. And currently now, I mean, I think one of the best reasons, and one reason I feel so comfortable doing it, I'm making an investment on a piece of property that is probably at 1985 or 90 values.
Exactly.
So it's pretty hard to see the downside even for the property, not even talking about the note, but it's just hard to see that property has much of a downside versus, say, in 2006-07, then obviously there's a little more variable in there.
Yeah, very different era. And I think that probably leads to some advantages of dealing with our company, is that we have a pretty good grasp on California and its cycles. And so, we would really tend to get very conservative in a year like 2006 and,
yes,
and draw in the reins and try to prevent people from being too aggressive with their money. Sometimes that didn't work because they took their money somewhere else.
Yeah, I was just thinking, unfortunately, that's one of the sad things was people, because we did back off on the trustees, they decided they had become so used to the Norris Group trustees and the regular payments that I don't know that they did their due diligence when they decided to move their money somewhere else. So,
yeah, they thought all trustees were equal, and then they're not.
Yeah, that's just not the case.
The term hard money, can you describe that to somebody who's never heard of it?
Yeah, I think it's just simply, the way I describe it is it's just really private money.
Mm-hmm.
It just means that it's you have a broker such as ourselves in the middle, you have a borrower over here, and then you have somebody that wants to lend the money here. And it's just private money, and it's that transaction that really is described as hard money.
Well, okay, but what's hard about it? I mean, if it was...
Well, I guess it's hard. One way it's hard, if you're looking at it from the borrower's perspective, it might be hard because it's going to be more expensive than, say, bank financing.
Right, it's more expensive.
Yes, so that's the connection there.
And I think what's interesting, too, is that when you're on the money side, and you see the interest rates in the paper 3.5 or whatever,
right?
And then you have a trustee offer it to you at 9.9. You think, okay, well, who in the world would borrow this money? Right. And I think what you really don't realize, unless you're in the business, is that 3.5% or 5% money literally is not available to an investor.
Exactly. And I mean, one of the best examples for me goes back to when we first met. You're probably as strong a client as I've met, and when we first started working together, you were borrowing hard money.
Exactly.
And once again, that's because it made sense for you.
Well, and for me, I mean, I can say that's, and we're going to get into the segment where we talk about who's the borrower of hard money. It's not always an investor. As a matter of fact, when you were in the business for a number of years, that wasn't even a client.
Yeah, that wasn't a client.
Who was the typical borrower at that point?
Yeah, back that was, 25 years ago. That seems so long ago.
Yeah, thanks.
For both of us. The typical client was usually your homeowner that actually lived in the house that was in some kind of financial trouble.
On a loan they already had on the property.
Exactly.
So you're either making them a second or a bigger first, and the odds of having a problem with that probably were pretty high.
Yeah, you're doing a loan that probably, it's almost like a very small Band-Aid for them. Yeah. It gets them out of the very initial panic situation they may be in, but then 3 months down the road they kind of wake up and now their situation is even worse than it was the 3 months prior.
So let's make it clear that we don't make that loan.
We will not make loans to owner-occupants, no.
Right, and sometimes the circumstances that we say no to would make perfect sense if you were just dealing with the fact that there was equity.
Yeah, that's one of the unique things about us is hard money can also be, say, termed an equity lender.
Exactly.
Which we really are an equity lender per se, but we also qualify the borrower.
Yes.
And even when it comes to, say, non-owner occupants, so people that don't live in the house, but they might have a rental or something of that nature, and you've heard me say this before, we tend to do loans for investors. We tend not to do situations for people that are one-time borrowers.
Exactly.
And by situations, I mean, as you maybe they're behind on their taxes or they have some kind of problem and they need to pull money out of a property, and usually once they do that, they're right back in the same situation. Where the borrower that we target, they generally have a lot of liquid cash. They're able to handle their day-to-day business. This is just something that we do for them that helps their business grow.